Hello, beautiful people, and welcome to another episode of Financial Fridays. In today's episode, we are going to be talking about saving and investing. And I just want to forewarn you, give kind of a disclosure. This is a very general overview when it comes to saving and investing, but this is where we're going to start because I'm making the assumption that some people have no idea, and then there are other people that are more experienced and they know a lot of things, but I want us all to have the same foundation. So this is a very general overview. So let's start with savings. When do we save? In general, the best time to save is always and often. As mentioned, different people are starting in different places financially. Some people are avid savers and know all about it, and other people are just getting started. So, a general rule of thumb is that whenever you receive income, to take a small portion of that and pay yourself first. This is something that I did not learn until later on in life, and oh my gosh, it's really small, but that consistent action is a game changer. So, when it comes to when should someone save, it is important to take a portion of your income whenever you receive income and set it aside for savings. Next, what amount should a person save? The answer to this question is not necessarily a direct answer because, again, everybody is in a different spot on their financial journey. But I will say, I think there are different stages when it comes to saving. And depending on which stage you're in, that might bring a little bit more clarity as to how much you should save or what portion of your income you should set aside for savings. So, the three different types of savers. We have the newbie, and when you're a newbie, you should save as much as you can. Newbies are typically like young adults, teenagers, young people off at university. They're out getting a job. It's their first job, or maybe, they've worked over the summers, whatever that might be. So you're just starting to get your feet wet financially, or you're someone who has been out doing, you have a job, you have a real job, a career, but you really are now starting to take your finances more seriously and you want to develop good habits. You would be in the newbie category. And as a newbie, it's ideal that you save no less than 10% of whatever your income is. No less. If you can save more, so if you're a teenager or a young adult and you're living at home and you don't have a lot of expenses, save up to 50% of your income. But if you're a young professional and you're out in the world and you have more responsibilities, be sure to save no less than 10% of whatever income you have coming in. Okay, the next stage is the stable saver. So this is someone who is probably more professional, more mature. They have an income that's coming in each month, and they have responsibilities, but they're able to put away a good portion of their money, or they have already developed the habit of saving. And for these people, I would say, again, no less than 10%, but ideally you should probably be saving 30%. And with that money that you've saved, if you've reached a certain level, you then want to start investing. Okay. The third stage is advanced. So people in this category typically have they for sure have their emergency fund saved. They also have an extension of that. So they have roughly 6 to 12 months of their living expenses saved, a cushion for an unexpected emergency, money in case they need to take care of someone or in case they have to quit their job to do something, in case something comes up unexpectedly. They have money set aside in savings. And that is the advanced group. Next, we're going to talk about investing. When should someone invest? The answer to this question is like savings, always, but it also depends on who you are, where you are on your financial journey, and what your objectives are when it comes to investing. Okay, what to invest in. So if you're a newbie at investing, I would say you should invest in yourself because honestly, truly, we are our best and most valuable investment. So when I say invest in yourself, I mean invest in courses, classes, advanced education. And I would also say start investing in tangible assets such as silver and gold. Now, there are other tangible assets, but they have a higher price point. Silver and gold have a lower price point and are easier and help us retain our wealth. Now, as a newbie, when you're investing in yourself and you're taking courses and classes, you're definitely learning a lot because there are so many different things that we can invest in. We can invest in gold and silver, businesses, real estate, fine art. There are so many different things. And the importance of investing in yourself is to really get that education so that you know what it is you're comfortable with investing in. Also, investing in something that piques your interest and something that you like and enjoy. When you've gone through this and you've learned, you then come to the next stage, which is a steady investor. And a steady investor is someone that will start to invest more, not only time and education, but now is going to start putting money like toward actual assets such as gold and silver, real estate, stocks, other larger tangible assets, as I said, businesses, fine art, jewelry, those sort of things. Now, for our more advanced investors, this is where it becomes a lot of fun. I mean, it's fun with the other stages as well because you're learning and you're growing, but the advanced stage of investing, that is where we make our money grow and we make it grow quickly. And so with this, we invest in, again, tangible assets, but larger tangible assets. So real estate, larger pieces of real estate, not just single family homes or a duplex, but now we're investing in apartment complexes, office buildings, strip malls, that sort of thing. We also invest in businesses, larger businesses. We can go in as a venture capitalist or as a silent partner. And then there are also lots of other tangible assets. The important thing is that when investing, first start by investing in yourself, educate yourself on various things to invest in, and go with the things that pique your interest. Okay, a couple of notes that I do want to mention that didn't really line up with any of the questions. First, when saving, save and have cash in the bank. Cash is always important. Now, there are a lot of financial teachers and educators that will tell you, like, when you save, you're losing money. And they are right after a certain point. This is something that I kind of had to figure out and sift through. The big thing is if you have $250,000 or more cash sitting in the bank, the cash over that amount is you're losing it. And what they mean by that is because of inflation and how things are going economically, the value, the purchasing power of your dollar is decreasing. That's number one. Number two, the FDIC only insures up to $250,000 per person. So it's not per account, it's just per person. So if you have more than that amount savings sitting in a bank account, you're losing money because your money can be working and earning for you. That's really important to note. So if you have more than $250,000 in a bank account, move anything above that $250,000 mark into other assets, whether it's gold, silver, real estate, businesses. Move it into another asset so that it's earning and it's making money for you on a regular basis. Okay, my next note is specific to investing, and it's an alternative vehicle to investing. It's nothing crazy or wild, I promise. It is not get rich quick. It is actually more unknown. I think it's something that's out there, but a lot of people don't talk about it or understand the full benefits of this particular vehicle. And it is quite amazing. And it's life insurance. Life insurance is more than just, hey, if you die, your family gets this money. There is an investment piece to it, and it is wonderful because it has really great tax benefits. So when it comes to our 401ks, our IRAs, and all of that, there we have options as far as when we're taxed and how much we're taxed. And our options often leave us with kind of a gamble as to like a roll of the dice. Are we going to be in a higher income tax bracket when we retire? Are we going to be in a lower income tax bracket? Do we pay taxes now and then put money into our 401k or IRA? Do we pay taxes when we take it out? There's a lot. Now, I am not a financial advisor in any form or capacity. I just want to make sure that that is very clear. I highly suggest that you look into life insurance, into whole life and or universal life insurance, because with those specific policies, you're able to overfund them. Again, definitely sit down and talk to a tax advisor, as someone that deals with life insurance so that they set you up correctly. But what's really great is that when you overfund that, that money is tax free. So it's like having a savings account that regardless of what's happening with the economy, that money is there. It's insured by the insurance company, not the FDIC. And you can obviously take that money out whenever, but it's tax free. So I would suggest look more into it. I think it's wonderful and it's super brilliant, and I'm surprised more people don't know about it, but look into it. And that's what I have to say as a side note to those two things. That is the end of this week's episode of Financial Fridays. I will see you guys next week. Definitely be sure to click the subscribe button and check out the website. I'll see you guys later. Bye.